and welcome to this special show where we will be discussing the July CPI data. Well, it is due anytime soon, and there is an expectation that it could probably harden all the way to around 6.6% for the month of July versus 4.8%. Now, the CPI surge is expected to be led by vegetable prices, and within vegetable prices, the key component is expected to be tomatoes, which is expected to lead the hardening. I think we do have the CPI data with us, which has come through, which has come in at 7.44%. So that is much higher than what we were anticipating, 7.44%. The street was working with a figure of around 6.6%. So it is definitely much more than what was expected. We will wait by for the food inflation data because that is expected to probably harden to all the way to around 9% and expected to be the key culprit in terms of hardening this time. We will wait by for the details and the internals, but in the meantime, we do have our guests with us. We have Lakshmi Iyer, who is the CEO Investment and Strategy at Kotak Alternate Asset Managers. We do have Aditi Nayar of ICRA, who is joining in as well, Aditi as well as Lakshmi. Thanks very much for taking the time out. 7.44%. Aditi, wanted your first thoughts.
Thanks, Ekta. Well, we had projected the CPI inflation for this month at 6.5%, but after seeing the WPI data earlier today, we were quite worried that what we had penciled in was going to be a sharp underestimate, and that's exactly what has turned out to be the case. But if we remove veggies, I think the good news is that the rest of the CPI inflation hasn't gone up too much. So as long as this shock ends up being transient, we should probably be able to come back to a more manageable CPI inflation trajectory in a few months. But yes, in the meantime, it's going to look pretty difficult. The numbers are going to look quite ugly, borrowing a word from Lata, for the next couple of months.
Okay, all right. Well, Lakshmi, what is your thought? Because the WPI data did contract to 1.3%, and that was much lesser than what we saw in the previous month, in the month of June. So was that an indicator that, yes, this CPI data for the month of July is going to be much worse than anticipated?
Well, Ekta, it was a precursor, but I think these numbers have been significantly beyond what the markets were expecting. I think up to 6.7 to 6.75 on the headline was kind of given, give or take 5-10 basis points. Again, definitely, as like what Aditi said, it's basically more to do with the tomato prices and the vegetable pack in general, which tends to mean revert by, say, by August end or early September. So that was not too much of an issue. I think the focus also therefore on the core, how the core numbers look like. I think that would be more, a guiding factor. But certainly the numbers are above the normal range that what the market was expecting.
Okay, yes, absolutely. In fact, this is the highest CPI data that we've seen since April of 2022. So maybe the trajectory should come up for you. In April of 2022, we had the CPI data which has spiked all the way to around 7.8%. Since then, we haven't seen a 7% fix which has come in on the CPI until now, where it's hardened all the way to around 7.44%. Well, Lakshmi, as Aditi said, the data X of tomatoes, or you have to look through the tomato inflation to basically assess what CPI is tracking at as well. So have you been able to probably get an idea in terms of what the CPI would be X of the one-offs?
Shweta, X of these prices, I think the numbers are still fairly docile. It's not really, threatening to blow off the top as of now. But as I said, the headline numbers definitely invoke a lot of, displeasure and discontent, and that's how it has been. But if you look through the details, I think that is what we need to probably, look through these numbers also. I think that will give us much more clarity in terms of, as they say, the devil lies in the details. So I think that's what we need to look for right now. If that is not significantly off what the numbers that have been projected, which is largely, marginally on the higher side, I think we should be okay.
Okay, well, we do have the food inflation data which has come through, and that's come in at 11.5%. The street was working with around 9% this time round. So it's come in much higher. It's come in double digits for the food inflation at 11.5%. This compares to 4.5% on a month-on-month basis. Obviously, the key culprit would be the vegetable basket, which would see inflation spike on a month-on-month basis. So that has really been the key culprit, 11.5% for food inflation. Aditi, wanted your thoughts on it. Much higher than anticipated.
No, absolutely. It is much higher than anticipated. There's no two ways of putting it. But the only hope we have is for the mean reversion that she was talking about and I was talking about earlier as well. So vegetable prices do tend to be highly volatile. Normally they are within a manageable range. This time the top of the range has just gone off the charts with what we've seen in the last month or so. And eventually, of course, we do expect that prices will come back down to a relatively normal seasonal level once the next harvest is in the market. But that is a couple of months away, so it is going to take some time, and we will have to live with these higher prices until then. And hopefully, the nature or the duration of the shock will be transient enough that we are not going to see any persistence or any transmission into the core inflation. Because if that starts to come in, that will be a big issue. That's not our base case at this point.
Okay, well, I do have the core inflation, which has been messaged to me. That's coming at around 4.9% in terms of preliminary calculation. So as of now, Aditi, it looks like it has not seeped into the core inflation data, which is basically the food inflation, the headline inflation. As of now, is not seeped into the core inflation data. Lakshmi, I wanted your thoughts on the core inflation, which is coming at around 4.9%. I think this compares to around 5.1% in the previous month. So there has been a little bit of softening. Your thoughts on that?
No, absolutely. If you look at, this number is lower than what you saw in the month of June, which was at about 5.1, and May was close to about 5.2%. The expectation for July was close to about the 5% mark, and I think we are just about beating that, undershooting that by about 10 basis points. So I think that is the crux, as we were discussing a few minutes back. It's important for market to focus on the core number, which means that the mean reversion that we just spoke a few minutes back seems to be, if that plays out, I think we should be fine.
Okay, all right. The mean reversion, if and when it plays out. And Jameel Pan, welcome to the show. 4.9% versus 5.1% is where the core inflation is coming at. What is your sense in terms of a trajectory for core in the next 2 to 3 months?
I believe if the inflation expectations don't surprise on the higher side, now the last survey definitely saw inflation expectations relatively steady, just a shade lower than the previous survey. So the critical thing that we need to look at if we have to analyze the second round implications of this inflation reading or relatively higher inflation readings for the next couple of months at least, into the generalized inflation or the core inflation, that will be pretty relevant. Otherwise, I think given the tightness in the sort of monetary policy and also higher food inflation eating into the expenditure baskets of a very significant portion of the population, relatively we should see core on the downside sort of bias. And I think the core by the end of the financial year could be around 4.7 or a 4.8%. So fairly enough, I don't think there is any significant worry on the core. But the worry is whether the higher food prices sort of translates into higher inflation expectations, and that could be of a worry. Now, here we are talking mostly of the vegetables, but if I look at some of the news prints that are coming through in terms of even chana prices having increased, of course, yes, chana to a certain extent the government has buffer stocks. The arhar prices have also relatively been on the higher side. So the edible oils, the pulses, the cereals, everything becomes relevant at this point in time. As for August year to date, month to date, even onion prices have been relatively on the higher side. So everything remains on the table. My feeling is that for anybody in the street, it's very difficult to have a very clear indication of where inflation could be headed by the end of March.
For how long do you expect food inflation to be elevated in your reading, Mr. Pan?
For the next month, yes. To a certain extent, we can see elevation continuing because, as I said, the onion prices, etc., have been moving higher. The good part of it, or the more statistical part of it, is that after that 175% jump in the tomato prices definitely have come down, and even though they might not subside all the way to the floor level immediately, on a month-on-month basis, the increase in the tomato prices could optically look quite lower compared to what we had seen in the previous month. So on a month-to-date basis, vegetable inflation per se is on the lower side. But as I said, it's not only about vegetables that we need to look at. It's about a lot of other sort of items on the food basket that we need to track. With this reading, I wonder whether the 6.2% inflation average for the current quarter, as RBI has penned down as its forecast, could actually be met.
Okay. All right. Aditi, Mr. Pan made the point that eventually a higher CPI could also feed into demand contracting, and hence we could probably see the core inflation contract towards the end of the year. What would that do, ex of food inflation, to the CPI as a whole?
See, first of all, I think the point that Indranil just made on the CPI inflation projection for Q2, I do agree. I also think that 6.2 looks difficult to meet right now, because at least in the month of August, we are unlikely to get the CPI inflation decelerating meaningfully, and only in September should we expect there to be some amount of cooling in the inflation print, although I still expect it to remain fairly elevated. So I think first of all, 6.2% is looking difficult to achieve. After that, for Q3, 5.7%, I think that is something that at this point in time I don't think is in danger of being overshot. But certainly the current quarter print, having seen today's data, that definitely is looking like something that is now possibly needs to be revised upward. If the vegetable price shock is transient, then the impact on demand should also be limited to a shorter period of time. And I do think that demand, or at least I'm hopeful the demand will be back to normal at least by the time the festive season kicks in. And this time, I mean, it's a little bit later than what it was last year. So hopefully by then, if overall vegetable prices have come back to a relatively normal level, then at least we should not see too much of an impact on festive demand, because a lot of manufacturers would be looking forward to a good festive season. And hopefully by that point in time, the overall household budget should be back to a relatively normal position.
Okay. Lakshmi, would you be of the opinion that 6.2 for Q2 FY24 is likely to be revised higher?
Because there are too many sum of moving parts right now. It's of course the top culprit is top, of course, as we know. But over and above that, even crude oil prices are behaving quite whimsical. And of course, you've seen some bit of pressure on the rupee. So at this juncture, if you were to ask just one view, it looks like the breach seems to be imminent. But of course, there is much that can happen in the next month also. And if this cool off actually starts materializing, we just think stability right now. We've not seen price point reductions. If you actually start seeing that, then some bit of that solace can be achievable. But as I said, for now, it seems to be a little bit wobbly or in a fluid situation, and therefore a breach on the higher side seems to be imminent.
Okay, all right. Mr. Pan, Lakshmi, as well as Aditi, just hold your thoughts. We need to take a quick break and we'll be back with further questions on this discussion. At 11.5% vegetable inflation, which is the key culprit, which has come in at around 37% for the month of July. Indranil Pan, Lakshmi Iyer, Aditi Nayar are still with us to take us through this discussion. Lakshmi, coming to you with regards to what you expect the RBI to do. They have held on to rates for the past 2 to 3 times that they've met. But what is your sense in terms of the trajectory that we could expect from the Reserve Bank of India going forward based on the inflation data that we're seeing?
I think some bit of the inflation, being led by vegetable prices is something which they had, factored into their own inflation forecast. Is sufficient, of course, time will tell, but looks like these numbers should not really change their, reasons to be on hold as yet. Crude oil prices, and I mentioned this earlier, one needs to keep watching out that, quite keenly. But anyways, we've just had the policy gone by, so it's too very early to comment on the next policy outcome. But clearly these are some of the triggers which cannot be completely denied, but for now it has to be an extended pause.
Okay, an extended pause. Mr. Pan, there are some economists of the view that eventually, probably going into next year, the first 3 months of next year, there could be a chance of a possible rate cut as well from the Reserve Bank of India. That's when the Fed will probably get a little more dovish. Inflation figures will probably cool off from what we are seeing today. Is that a possibility in your analysis?
Very honestly, as a disclaimer, I think it's too long away. And given the uncertainties that we have seen not only from the global atmosphere, but also with the sudden spike in inflation, etc., it's a very difficult call. But if I just purely look at our own inflation estimates and take into consideration the inflation estimates that has been provided by the Reserve Bank of India for Q1, at 5.2% and a 6.5% repo, the positive real interest rate is 130 basis points, which I think shouldn't be too much of a bother for the Reserve Bank of India, assuming that the growth continues to hold in the 6 to 6.5% sort of zone. Now, whether we will be directly influenced by the Federal Reserve and therefore move into a rate cut, very difficult to say. Simply because if there is a significant slowdown in the US along with the rest of the globe, then I think my case is more in terms of a risk aversion and therefore a currency depreciation rather than sort of a very softer inflation and growth sort of falling off the cliff from a domestic perspective. So I would sort of, for me, I would bet on Q1 of the next financial year to continue to be on a pause and look at any chance of reduction in